and welcome once again to Tuesdays with Lloyd's, a continuing virtual conversation with Lloyd's underwriters and their distribution partners in both London and the U.S. My name is Pat Talley, Regional Director and Managing Agent Practice Group Leader for Lloyd's in the U.S. Today, our roundtable discussion will focus on one of the fastest growing and most significant risks we currently face, cyber. It would be difficult to find a more timely topic given the growing number of cyber attacks that have dominated recent news cycles. While the Colonial Pipeline and JBS Beef ransomware events are a few of the more highly publicized occurrences, they are but a few in a seemingly endless and growing wave of sophisticated attacks. Cyber risk is rapidly evolving in terms of loss causes, driven by the increasing digitization of the economy. Cyber attacks are becoming more frequent and costly, with organized crime syndicates and state-sponsored groups being the main perpetrators. The insurance market is responding, with cyber insurance being one of the fastest growing lines worldwide. To ensure sustainable growth, regulatory bodies are calling for increased understanding of the risk of economic loss from cyber-led events. So let's explore in more detail the current state of affairs and how the industry is dealing with it. Joining our panel of experts today are Gillian Anderson, Global Line Head of Cyber and Technology at SCOR Channel; Laila Khudairi, Divisional Head of Enterprise Risk at Tokio Marine Kiln; and Jacqueline Spencer-Sim, Divisional Head of Cyber at Hamilton Group. Our moderator for today's session is Kaitlin Upchurch, Senior Vice President and Cyber Practice Zone Leader at Marsh. We've included a brief biography for each of our panelists in the chat box for your further review. Before we begin, some quick housekeeping. We encourage you to participate as much as possible and to submit questions, but please do this via the Q&A tool as opposed to the chat feature, as it makes managing the quick Q&A easier on our end. Today's session is being streamed live on Lloyd's YouTube channel and will be recorded to allow future on-demand viewing. We hope you'll refer the channel to colleagues and clients you think might have an interest, and we'll drop a link to the channel in the chat box momentarily. And with that, welcome again to our guests, and Kaitlin, the floor is yours.
All right, good morning and good afternoon, everybody. Thank you so much for having me. And gosh, when we planned the session several months ago, we had no idea what was ahead of us. We had a sense of what could be ahead of us, but we certainly didn't realize that we'd be in the situation we are today with just the complexity of cyber insurance. So I think it's fitting that we're all getting together just before 7/1. Our goal for today's session is to hear directly from the trenches. What is happening in the cyber insurance market? How did we get here? What lies ahead? And what action items can each of us take after this session that will arm us with more confidence to tackle the balance of the year and to prepare for 2022 in the world of cyber insurance? So we hope that this session will be helpful and informative for all of the audience members on the line, whether you come to the table as an underwriter, as a broker, as a risk manager, or somebody else in the discussion. So let's jump right in. The panelists this morning and this afternoon in the UK, we have prepared a few key questions that I'm going to tee up to the group and just get some diverse opinions and feedback as to their perspectives. And then we will open it up for questions at the end. So we look forward to a very interactive discussion today. So the first question I have for the group, and actually, Gillian, if you could start off with this one, I wanted to get your perspective on the recent history of cyber insurance. What's been going on over the last 3 to 4 years, and how did we get to the point where we're at today?
Thanks, Kaitlin. I would say really some of the main drivers about where we are today have come from, I guess, where the market started. So the kind of height of the market was very much at the peak of the soft market for other lines of business. And so that really drove the interest in cyber and the growth in cyber. It was viewed as a big growth opportunity for a lot of insurers, a lot of broking communities as well. And I think, because of that, there was a big influx of capacity into the marketplace, and terms and conditions were broader. There was a lot of chat around the systemic exposure, but it was a very theoretical view. And certainly over the last 3 years, I think what we've seen is an increase in threat landscape, the sophistication of events, the risk profile of companies not quite keeping up in some cases with the sophistication of those events, and also just a general kind of influx of events happening. The frequency's certainly been up in the last 3 to 4 years.
Laila, curious your perspective on this.
Yeah, I mean, much the same as Gillian just described. I suppose it's also worth thinking we had this influx of capacity a number of years ago, as not only did sort of insurers see opportunity, but the demand for coverage increased massively, really between kind of 4 to 5 years ago. But given the increased claims that Gillian just described, there is now a reduction in capacity happening. So from really sort of mid-2020 onwards, insurers have been looking at the profitability of cyber. Gillian described broadening of terms and conditions, often price coming down following that influx of capacity a few years ago. And at the same time, we saw the claims increase. So clearly not a good formula for writing a profitable class of business. And that increase in claims has been quite dramatic from 2019 into 2020, and a stark difference to what we saw in 16 and 17. So this year, the end of 2020 and throughout 2021, and Kaitlin, you as a broker, I'm sure experienced this also, there has been quite a big reduction in capacity also.
So just kind of keeping in the same theme of, the market over the past 3 to 4 years, you guys are talking about just the increased interest and, volume of folks coming to you guys, but potentially this capacity concern. I mean, can you talk a little bit, maybe Laila, you talk about your desk, just your day to day, you're logging onto your computer, you're getting submissions, what was it like 3 or 4 years ago, and then sort of how has that progressed with the development of this product in the last 3 to 4 years? Granted, we sprinkled in a global pandemic in the midst of all of that, so I'm sure that helped things.
So I'd say the cyber market it's really evolved. I mean, it's grown in sophistication. The underwriting questions we were asking probably more 6 years ago were, in hindsight, fairly basic. But the claims landscape was also one where there was far less claims frequency. So now the risk selection angle is kind of ever more important, because especially a company who is protecting themselves from the ransomware threat, or as much as they can, is going to be something an underwriter is very much focusing on. So the underwriting questions we're asking now, there are more of them. We certainly get the feedback that, too many questions and why are underwriters being difficult? And it's just down to risk selection. It is important for us to do that. And it's because of that claims frequency. So the amount of underwriting questions asked, yes, they have increased. Insurers have adapted their appetite. Certain industries that were seen as high risk may have come down in the sort of hazard class within cyber, and then other industries have increased, so their pricing has increased, and that's just following loss experience as well. Just as with any other line of business, the difference is the other lines of business had 50 or 100 years to kind of find their way, whereas cyber's only been able to do that over really the last 5 years. In terms of day to day, we're probably not that dissimilar to other lines, apart from we do a lot more electronically. So within the Lloyd's market, pre-pandemic, most other lines of business are quoted at Lloyd's, whereas the cyber market tends to be quite email driven, which is kind of in line with what you'd expect from a technology market.
So you're getting just a few emails lately, I imagine.
Yes.
The blessing and the curse of email. Well, I'd like to hear a little bit from Jackie, so I'm going to turn it over to her with a question. I know that Laila and Gillian spoke a little bit about the coverage broadening over the past 3 years, and curious, Jackie, how important has that been for this product? Certainly, if you have any other commentary just with respect to the market or your day-to-day that you want to throw in as part of your answer, we'd be interested to hear what you're seeing.
Yeah, sure. I think it's incredibly important. And I don't think I'm going to talk about like kind of the grey areas of other lines of insurance coming into cyber, like full media liability, supply chain crime, or anything, for example, which you can argue which is broadened the coverage and stuff like that. And we need to probably reflect to decide where that's best placed. But I think it's better just to talk about the how and the why of the broadening of coverage, and which is fundamentally, as Gillian and Laila said, is information security networks liability coverage. And so if we go back to 94 to 2000, it's often referred to as the dot-com bubble. And it's a time where the world experienced a massive amount of internet adoption. And so in response to that, in the late 1990s, we saw the first cyber liability insurance products start to arise. And they quickly gained popularity. They were kind of like a protection for unauthorized access, computer viruses, data loss, basically InfoSec. And then I suppose that the real boom of this came like a decade later, early 2000s, 2007, when we saw the launch of the kind of breach response products and stuff like that. And it's now almost another decade later that we're starting to see the product finally develop to where it should be. And I think as the new technologies have come along, the cyber industry, we've had to adapt. With underwriters and brokers, we've always tried to be proactive, not reactive. There's various centres of excellences in both underwriting and broking houses. There's the adoption of AI to quote and bind business. And there are now so many breach coaches, forensic investigators, it's impossible to count. And the thing is, what we need to remember is it's expected in cyber more than any other type of insurance. And we're okay with that. It's what we've always done. But I think as the technology evolved, so has the product. And the word broadening is quite difficult. It's a bit of a misleading word because it makes it sound like cyber's so wide now, we'll write anything. And we don't. We're evolving. We're not broadening. And I think that's one of the best things about the ability of our industry is we're able to evaluate risk, provide the coverage where others may not, and then work with experts on our vendor panels to ensure that cyber insurance continues to grow, shrink, and mature. When we look at cyber, we look at as a peril. We understand the exposure, like other classes of business. We understand the severity and we understand the frequency. And obviously that's been reflected at the moment in the hard market we're in. So I don't think it's a question of broadening or restricting coverage. I think it's a question of evaluating those three components of risk I just mentioned, and then providing adequate coverage for both clients and for our own risk transfer. And I think cyber coverage is always changing, and I hope it always does. It's what makes our product exciting. It allows us all to be innovative. We all have diverse books of business. We all see risks slightly different, and we have the flexibility to add coverage where we see fit. And yes, the last few years have been a bit of a game changer in terms of what individual companies will and will not write. But like Laila just said, gone are the days where a renewal application will get you terms. We now have full complex underwriting processes, but we are writing a complex risk. And with that comes certain expectations of the client and the broker. And so it's not about broadening wordings, it's about diversifying wordings and finding the right coverage for the right risk transfer.
It's interesting you say that it's not about a broadening of coverage, and I have to agree because I receive many comments from clients that say that they perhaps were not interested in a cyber insurance product many years ago, or when they say many, they might even say 5 years ago, because the product was still evolving, and now it's broader and it offers more. And the reality is that these coverage components, the business interruption, the cyber extortion, the business continuity components of a cyber insurance policy have been there for some time. It's just the notoriety of those coverage applications in context of the actual risk issues that businesses are facing every day was maybe not brought to light as much as it is now. So I have to agree with you that, the coverage, it's not necessarily that it's been broadening, it's been sort of adapting the underwriting focus to what the actual risk is of the individual business. So Gillian, any comments from your perspective about the wording, how it's changed, how the product fits the needs of clients maybe today as opposed to the product a few years ago?
Yeah, I think it's interesting just to touch on your point, Kaitlin, around the difference between the question marks at the moment around the sustainability of the market versus only a couple of years ago, the questions were around whether the product was actually a viable product and worthwhile purchasing. And I think
she dropped the mic on an important point about whether the product is viable. Don't leave us hanging, Gillian.
Yeah. Yes, I think we've definitely seen that the product is viable and it has responded to claims, and probably has responded in a way that we didn't even necessarily contemplate, but has been beneficial to many insurers, particularly over this COVID period. I think there wouldn't be an insured out there that would argue the product hasn't worked the way that they expected it to. And then I guess to the points around broadening of coverage, the market has evolved in line with what the client needs. So business interruption was a big focus, but then, the push out to contingent business interruption to understand that supply chain risk that our insureds have, the market has responded and evolved to that. And with that and with the threat landscape, the risk has evolved. And so I think it just has to be a continuous process of reviewing what we're intending to cover, having the clients review what they feel their key exposures are and focus on that on a per risk basis, rather than perhaps the approach of the past of a kind of bucket list of all these coverages, some of which aren't necessarily relevant to the client. And I think that's where we need to get to, is a more selective approach to the coverages that actually apply to the risk profile of the insured.
Interesting. I think one of the other comments that I get a lot is, what are we not thinking about that's not covered? And I think that while I would argue that cyber insurance, the reason we're in the situation we are with prices escalating and risk selection is because the product's working. But to your point, I think the importance is not to take the product off the shelf and think about, what are we not covered for, but take your risk and think about what's our risk transfer that we're really trying to design, and think about the insurance product from that perspective. So let's talk about. Go ahead.
Sorry, just to add to that point, I think it's been touched on already, the level of sophistication and understanding of the underwriters of the risk profile of insureds, the amount of investment from the insurance market into technology experts to really work with clients to understand that risk profile. I think these are all great additions to our market that have developed over the last 3 years that really make our products, more comprehensive and stand up and work well for our insureds.
So if we think about understanding the risk selection of our clients and the businesses and the unique exposures, obviously we can underwrite as best we can, but we can't prevent claims in the cyber world. There's some stuff we can project maybe a little bit of the probability or likelihood, but Laila, talk to us a little bit about the claims that you're seeing at the moment, the frequency, the types, like what's it look like on your desk right now?
Yeah, sure. So as mentioned, there are more claims now than there were 4 or 5 years ago. I think every cyber market would have a similar response there. The trend or the most frequent claim at the moment is ransomware. I don't think that would come as a surprise to anyone in the virtual audience. Absolutely, we have seen more ransomware and more sort of higher severity ransomware as well. So just as reported in the media, the criminals have cottoned on to the fact that you can actually ask for more money and still sometimes get paid those extortion amounts. And that's kind of been ticking upwards really over the last 3 years. So it's quite scary what they're able to achieve and how, you know, crippling a ransomware attack can be. We have seen those, and we've seen them across, you know, a number of industries. I think manufacturing gets talked about a fair bit, but actually there aren't, you know, many industries who have been immune to this ransomware epidemic. I think the key point is implementing the controls that can prevent the successful ransomware attack from happening. But it's not all about ransomware. We still see data breaches, and some of those may emanate from ransomware, but actually just your kind of, you know, bread and butter, if you like, original data breaches of a few years ago, those are still occurring. They do not receive the same publicity always as other losses do. So they're kind of, you know, within the market and often in the tens of millions in terms of the cost, but they're not publicized in the media. But obviously they're still, you know, affecting our insureds and affecting insurers' bottom lines. And privacy breaches as well. So the biometric statutes in the US are causing a lot of issues at the moment. There are, I mean, we talk about coverage broadening in the market. I probably disagree a little bit with Jackie and Gillian in that I think the gut coverage has broadened too much. I think we've reached a point where you need to really think about what's sustainable, and the coverages such as the contingent business interruption, so non-technology service providers going down and resulting in business interruption losses. I think those could result in, if given with too much frequency, in an unsustainable market. Those losses, we had Colonial Pipeline recently. Are we going to see more of that? We'll see. But for the time being, it is ransomware as you'd expect, plus data breaches.
Jackie, what about you? What are you seeing on the claim side?
Yeah, I think it's similar to what Laila just said as well. And I think what kind of in response to when about the broadening of the market and the coverages, it's more about, I think we mentioned that when it's not about we're evolving, our coverage is evolving, which is in terms of making it more useful for clients. But I think in terms of, take for example, the non-IT service providers in the contingent BI, we don't want that product in our policy. We try not to put it in our product. And I think that's where we go back to what you said as well, Kaitlin, just looking about what the actual risk is there and what's been there. And it's more about tightening up those grey areas. I think as well, again, it is not just all about ransom. There are still the attritional losses coming in, kind of call it like a death by 1,000 cuts by the smaller ones that go unnoticed, that kind of build up that book, particularly when you write some of the smaller clients, not so much the large corporates that have the kind of self-insured retentions to kind of help with the ransom attacks and stuff like that. And again, I think that goes back to lack of understanding of the true cyber risk when you're looking at what needs to be covered within a cyber product. And I know I mentioned earlier, like the media liability or the crime or miscellaneous tech E&O, whatever it may be. There's this kind of whole push a few years ago to pull out the silent cyber, affirmative, non-affirmative cover and stuff like that. But there's not been real thought to where it should lie. And so like the trigger of the risk, obviously, if you're providing any type of insurance, should that really matter? If you're providing a liability insurance for a breach of contract, for example, if the risk happens to be because something's been hacked, should that matter that that's a cyber trigger? Probably not. And I think none of us want to turn around and go to our managers and say, by the way, I've had this loss, and they're wondering why it's in the coverage in the first place. And I think those are kind of those losses that are kind of going under the radar at the moment, because as Laila said, everyone's quite focused on ransom events and the BI events that come up with that, and the cyber, the privacy events that come from having a ransom attack on your own systems. I think that we just need to make sure that those attritional losses don't go go forgotten. Everybody's looking at pulling, when we talk about reserving and we talk about how the market performs, it's all about ransom, about taking ransom coverage out and then making it look pretty. I think for the last 10 years, 15 years, we've been quite profitable business. We are a profitable business, and which again, I think that's with the low severity of those claims coming in. We've had the big, large ones, not much liability with those. And so I think where we look at, when we look at claims that come across our desks, yes, the majority of them are ransom events, but yes, we are starting to see those kind of credit card losses again, those business interruptions from a network error. People automatically are presuming it's a ransom event, but it's not necessarily someone's been held to ransom. It's just a malware or something that's been affected.
So you made the point about nobody wants to go to their boss and sort of explain the claim scenario that happened. Maybe you didn't potentially underwrite for, couldn't have thought to underwrite for, or, you know, certainly things happen even if you try to understand the risk completely. But Gillian, I mean, how on earth are you guys underwriting and deciding the price on the risk? Can you talk to us a little bit about your process as it sits today, and maybe what you expect a little bit for the balance of 2021?
Yeah, I mean, I think appetite restrictions have definitely become more obvious over the last couple of years. Previously, I think everyone's appetite kind of felt roughly similar across industry groups, which was really driven by there not being much loss activity. Now, my book versus Laila's book versus Jackie's book, our views on those industry groups would be very different based on our loss experience, which is not something that we've ever really had, if I can say, the benefit or the maybe not so much of a benefit. So I think very much risk appetite, sticking to risk appetite, risk profile, like we have our own red flags for what we expect or what we don't expect to see on a risk. And it's a fairly hard line now when it comes to those red flags, when it comes to ransomware. So I really think that focus needs to be around the risk selection process. And, you know, the attachment point matter, that's a difficult one to discuss because we've seen the changes in ransomware and the extortion demands and how these are moving. So I really, you know, think the focus has to be on a risk by risk basis and contemplating those risk controls that they have in place.
What about you, Laila? How are you underwriting and deciding how to price a risk?
I agree completely with Gillian on the risk selection points. That's absolutely critical. And as I mentioned earlier, the questions we're asking now are a lot more detailed than before. In terms of how we're pricing, the cyber market, I think this is fairly common. Obviously, the individual pricing is different, but generally we're pricing on industry, the geographic location, and the number of customers the insured has for the privacy exposure, and reliance on technology for the business interruption exposure. So the industry kind of tells you a little bit about obviously the privacy exposure and the reliance on technology. The industry sector will tell you what type of information the insured is storing, whether it's healthcare information or credit card information or just simply sort of names and emails. And then clearly the coverage, but that one's kind of obvious. But the industry and the geographic location, is important for what the legal landscape is in that territory. So what are the privacy laws, what are the data breach notification laws, and what is the likelihood of, for example, class actions or liability. The sort of main proxy, I suppose, that the market use for BI and number of records is revenue. So that's, you know, often why revenue is asked for, but it's really to get an understanding of customer base and business interruption exposure.
I'm going to put my broker hat on for a moment and ask you ladies, you know, you both mentioned industries, and at least from where I sit in Texas, I have a diverse array of industries where on the surface, I would like to think that risk selection within the industry, even if the industry is tricky, does prove to give some benefit to the insured if they have gone above and beyond their peers with respect to cybersecurity investment. So how might clients get around the fact that certain industries may be immediate red flags? I mean, do you guys say, you know, close for business, or are you taking another peek under the hood if you feel like there's truly a risk that is within a tougher industry that you feel like maybe has actually gone above and beyond with respect to cybersecurity improvements?
So often the latter. Often we're looking at that specific insured and what their controls are and how they've mitigated against their cyber risk. There are certain industries, and airlines, for example, is one that at TMK, we have completely stopped writing. And I know that's difficult as a broker if you have an airline that you're trying to place a cyber placement for, but the frequency and severity of losses there have just been disproportionate to other industries. So we do have some industry sectors that we simply won't look at, but most of the time we want to look at the individual insured.
Thank you. Okay, so I have a final question for all of the panelists, and you know, for those of you that are still listening, we'll do some Q&A here at the end. There's actually a bunch of questions in the Q&A box, which I've been trying to look over. But one of the things that I personally feel is very important when you have these sessions is for everybody to have a takeaway. You know, now that we've heard some of the comments from the ladies on the panel, what can each of us from where we sit, either underwriter, broker, risk manager, client, wherever you are, what can we do to be more prepared and more confident moving forward for the balance of the year? Because this is not going to change anytime soon. So let's start with Jackie. I mean, best advice for any audience, you know, perspective that you want to select as far as the takeaway, what somebody should remember from this discussion today.
Yeah, sure. I think it kind of goes back to what the girls just said a minute ago in terms of looking at risk selection and industry and stuff like that. Like Laila just said, there are certain classes that people, that syndicates, MGAs have decided not to underwrite, and we look at it kind of, like you said, under the hood to make sure that the client has adequate controls rather than industries, and that's just as us as underwriters. And so I think something that clients should consider is that they're not just a complete uninsurable and never going to be able to get insurance again. I think that they should just, as a helpful action point, it's all about preparation and to triage accounts, work with clients, work with experts to make sure that when they're presenting a risk, it's presenting to the best possible risk that they can. And I think it's our duty to help, it's not to hinder. And I think that as we go into more of a hardening market, I think having that preparation with whether it be the risk management assessments or the questions or the underwriting calls, just work with the underwriters, work with the clients to make sure that everybody's prepared as best as they can be so that they can get insurance.
Laila, what about you? Your thoughts on a key takeaway for the audience?
Yeah, key takeaway. I'll focus mine on the brokers who are listening in. mine would be to invest in this product. You know, we still see a number of broking houses, especially the kind of smaller or more regional brokers, who do not have like a cyber specific broker, a cyber specific team. I think the last few years have taught us that this product is here to stay. It's no longer that, you know, really tough sell that it was 10 years ago. It's a, you know, essential coverage. And there are still a number of insureds and companies across the US and globally who do not purchase cyber. So I think there's, you know, opportunity there and a chance for more kind of brokers to shine. No one wants to sell a coverage that they sort of don't know about. So I'd encourage people to really invest the time into it.
Hey, and if you invest the time in it, you can be a YouTube star like we are. Apparently this is being broadcasted live on YouTube. Always want to be a YouTube star. Yeah, that's a great point, Laila, because there are so many folks that are reserved or nervous about making the investment and learning about cyber. All of us on the line here, we're at that point. And, you know, businesses rely on technology. And so understanding how you insure the risk of that technology is just what the risk management future will be tasked with. And so it behooves any professional in the industry to start to take a little ownership in understanding the product, understanding the risk. Understanding the risk will help you understand a lot more about the product, in my opinion. So Gillian, final comments from you, key takeaways for the audience?
Yeah, thanks. I think probably ties into what Laila said around the nervousness of some people buying the product, and also some of the reports around, you know, all of a sudden these questions around profitability and sustainability of the market. These aren't new questions to the cyber market. These are matters that we've been discussing for years. There's been huge amounts of investment into modelling firms to look at the systemic exposures. You know, there's consideration given to the moving risk profile, the pricing adequacy. We see that through Lloyd. So these aren't new issues to us. And I think what I'd say is don't be put off by that kind of press, because actually the market has adapted and it will continue to adapt, and the product will continue to evolve to be a meaningful product for the future.
Yeah, and that's there's a bunch of questions in here about, you know, what are expected profitabilities and loss ratios, and I know you kind of spoke to that point, but Laila or Jackie, any other comments about just, you know, is this a market cycle and the product, the insurers are committed to the product being here to stay, or should folks be worried that, you know, these scary press releases about another ransomware attack is going to affect the ability for insurers to offer cyber insurance?
No, I mean, absolutely, we are here to stay, and we're going through a hard market. It's the cyber's first hard market. When I first started, yes, there wasn't, the products weren't out what they are today, but there were still purchasers, but a lot of people get it from other lines of business as well. They didn't have the first party aspect, the risk management side. That's evolved over the last 10, 15 years. But we are, cyber is a profitable market. We do have losses, but we're learning about those losses. We're learning to adapt to those losses. We've invested a lot of risk management, a lot of time and a lot of effort to get the product to where it is, to get the experts involved that we need to get involved. We've evolved as the product's evolved, and I think the clients are evolving as well, and it is still profitable, it is still sustainable. And I think just because we are the market that's in the headlines at the moment, who says who it's going to be next year? It was a different class of business a few years ago. Next year it will be, I suppose, fish and chip wrapper, as we would say.
That sounds appealing. I think I'll stick with it a little longer if it's going to be fish and chips in 2022. I mean, there's a question about the parallel between this hard market and other product lines. Laila, any thoughts from your perspective about how this is different or maybe the same as what we've seen in other insurance lines? We'll pick on D&O because that is just kind of phasing out of their really firming market.
Yeah, I wouldn't say cyber's in a hard market. It's harder, but I wouldn't say it's a hard market. And I mean, what's happening at the moment is really a price correction. Yes, cyber was profitable at one point in time, but right now it's not. It may be for individual syndicates or individual companies, but overall, as far as I'm aware, it's not. So the price correction is happening. It has caused a harder market. I think there's more to come, and I think it's necessary for the sustainability of the market.
I think that's an excellent point. And it has to do with, if I may offer a takeaway for the group before we dig into more of the Q&A, let's take a vote between Jackie and Gillian. Are we in a hard market? Yes or no? Gillian, what do you think?
I would say no. I think there's still more room to go for a couple of years.
Yeah, I'd agree. I think the market is hardening, but it's still got a while to before we get to that full circle.
Well, good, because I have a few 7-1 submissions I need to discuss with you guys at the end of this call. So I just wanted to make sure we were all on the same page. No, in all seriousness, I think, that's one of the challenges with a product that is, my takeaway, if anything, is a product that is maybe not understood as deeply as some of the other product lines. It's easy to grasp onto the headlines and read the scary, provocative stories about, cyber insurance going away, or ransomware payments not being offered, or the continued viability of the cyber insurance market. And so I would just encourage folks on the phone to really dig into those headlines and to ask the questions of the people that are in this all day, every day. Because there's more to the story, and at least for the folks on this call, we plan to be around and offering more YouTube sessions on the continued evolution of the cyber insurance market. Okay, so let's get into some of the Q&A with the last 10 minutes or so that we have left. So there's the question about self-insured retentions and quota shares. So I don't know which of you wants to answer, maybe Jackie. How have you guys changed your perspective on agreeing to jump on a program with respect to the insured taking on a higher self-insured retention, and also in exchange for your offering of certain participation on a quota share program?
Yeah, I think it's great. It's about time that people always talk about cyber as a cat risk, and we're paying this and paying that, but there's not been that true investment in it. And I think recognizing that you have to have a kind of a bit of skin in the game will make you realize that this is actually a product that will help you, not hinder you. Co-insurance is not a new thing. We used to have co-insurance on business interruptions as standard, and it kind of just disappeared as the product evolved, and now it's kind of come back again, which is a great thing, because I think co-insurance should be here, or a self-insured retention. How can a product be viable if you're paying a 10 million limit and you've only got to pay, 10 grand to as the excess? It doesn't make sense. And so I think having more higher retentions, more co-insurance is the way that the product should be and should have always been.
So going back a little bit to sort of pricing and the SIR, because I that's an excellent point about the trade-off of $10,000 for a $10 million event for something that may be an easily $10 million event. Laila, you had made a comment earlier, and maybe I think somebody else, maybe Gillian did as well, about the geographic location and kind of how you're deciding risk selection. The comment and the question is, cyber seems to know no geographic boundaries, rather attacks may originate geographically, but little more. Any perspective or color on how you look at location as an underwriting factor?
Yeah, very good comment in the Q&A tool. Absolutely, cyber does not know geographic boundaries. The pricing kind of rationale there is more around the legislation in that territory. So it's not so much the cyber risk, it's more the regulation and the laws around privacy and data breaches and personal information, which does change depending on if you're in the US, in Europe, in different parts of Asia. So the data breach notification laws that result or that impact a data breach and either require a company to notify or not, and via which type of channel the required notification is, will vary by territory. So that's why we take that into account when we're pricing. And then also the likelihood of litigation and what kind of litigation you might see. So class actions are not, they're not a sort of global phenomenon. They are far more prevalent in the US and in Australia. So again, that's factored into the pricing.
And there's a good question about, speaking of litigation, about what you guys have seen in terms of fines or prosecutions from GDPR. Does anybody want to comment on that?
I'll take that one. Yeah, I think we've obviously seen the fines and penalties for some large clients, which have been I think there's definitely some regulators that are more active than others, France being one of them, but we've also seen those fines and penalties come down. There's been large reports in the press of some very large fines and penalties around the use of data, and so I think it's just interesting to see the evolution of it from, just the data breach, true data breach, to more around the wrongful collection, wrongful use of data, and how that evolves over time, because I think that is something that, is quite a substantial coverage change for the market as well, that we're still to see develop over time.
So Jackie or Laila, do you believe that the cyber insurance product should go beyond the bounds of privacy and security breach to trigger data collection issues, or should we keep it within the confines of you have a data breach, you have a security breach, therefore you have resulting fines and penalties coverage for breaches of data?
I'll go first. No, I think where the coverage is at the moment, I think we are ultimately information security, network liability insurance, and I think that's what we need to remember, and that's where the basis of the coverages should come from. The regulatory fines and penalties kind of a part and parcel of that liability portion of what we do. We've been fortunate enough in the market that the liability, actual third-party liability, class actions, etc., hasn't been as forthcoming as it would have been in other classes of business. And I think the coverage where we have now in terms of the regulatory environment is where it should be.
Kaitlin, good question. My sort of view on that is that the coverage needs to cover a fortuitous event. And if a company is collecting data that's in breach of a certain regulation or sort of law or legislation, then that shouldn't be covered by the insurance policy. So I think that is an area where, especially with regards to, for example, BIPA, the coverage is overly broad.
Okay, so let's talk about another hotly debated topic, ransom payment coverage. There's a comment in the chat about, do you see more insurers following AXA XL's example of not insuring the ransom payment coverage out of France? So hot debate on that in the US with our domestic insurers. So very curious, any of your opinions on the payment of ransom demands and the future of whether or not that should or could or will be insured in the cyber insurance market.
Should I go first on this one? So I think there's a lot of chat about the legality of paying the extortion demands, and whether, you know, there should just blanket, we shouldn't be able to pay them anymore. I think that would be very difficult to enforce. And also I think the gap at the moment between the level of sophistication of attacks that we're seeing versus the level of sophistication of some of the controls, even of the large corporates that we're looking at, there's still a gap there, and there's still work that needs to be done from an insurer, broker and insurer perspective to try and close that gap. So I think to move to not paying those ransoms now could potentially cause more disruption and kind of uncertainty in the market at the moment. But perhaps in the longer term, as that gap starts to close, that's something to think about.
I'll just carry on from there. I think it's got to be more of a collective approach. We are a quota share market, and individually, if companies take the stances to not pay ransoms, etc., then brokers and clients will just move on to another managing agency that will pay it. So I think, and there are kind of a lot of stuff that we do in the background to try and work out what can be done and stuff like that as companies and as like the LMA and stuff like that. So I think just it's hard to just to put a hard stance on it, because there will always be someone that is willing to provide that coverage. And so it has to be a collective discussion, a collective agreement that when we are able to make that decision, and it's not just insurance agencies, it's like you mentioned, Kaitlin, in the US, it's got to be with local, with government enforcement, law enforcement, etc., to make sure that we've got a proper stance, that we're not hindering our clients. And also then it goes back to the argument as to, if you don't pay the ransom, you're paying all the business interruption loss anyway, and talking about mitigating the risk and the coverages and the losses that are coming in now. If we're paying a business interruption loss on an event that is potentially can be hindered because we're not paying that ransom, that's a really difficult question to answer. So I think it's not just as clear cut as, are we going to stop paying?
Laila, any final comments on that?
Yes, it's a difficult question to answer, isn't it? Because it's a bit of a crystal ball kind of thing. Right now, we're able to continue providing the coverage, and we are hoping that we're underwriting around the risk, that the risk selection requirements and the underwriting information that we're asking for means that we are providing coverage to those insureds that have invested in, you know, anti-ransomware, let's call it, technology. If the frequency and severity continues to increase, I imagine the entirety of the market will need to take a step back and revisit that. Obviously, AXA in France already have. I think even in the current market, insureds that haven't invested in sort of those anti-ransomware tools would struggle to receive the ransomware coverage. But it is one of those areas where I think in 6 months' time or a year from now, we'll have a better idea.
So I have one final question for the group, but before I do that, I'll pick on you, Laila, since you were the last to answer the crystal ball question. And we have this lingering question in the chat about what gross loss ratio, are you hoping to achieve in 2022? So.
Yeah, I think I'll answer that by saying we have lost money because of the amount of claims and the size of claims we've seen. So for 2022, the market needs to return to profitability. Otherwise, it's too many years of unprofitable business.
So maybe a consensus from the group that everybody needs to have some degree of profitability, and we'll leave it at that.
Agreed.
All right. So in closing, I mean, this can be a question maybe important for the underwriters on the line to hear, but more importantly for the brokers and maybe any risk managers or clients on the line. How on earth do we project what our clients should expect for their renewals for the balance of the year. I mean, we can track rate data. We can kind of tell them a little bit about industry class. We can look at their controls. But even that aside, how do we know? How do we talk to our clients about, you know, whether the renewal will be viable, whether the renewal will be priced double the expiring, triple the expiring, 25% over expiring? Any guidance from where you sit right now halfway through the year would be appreciated.
Okay. I'd say speak to your insurer or broker early. That's the key point. We want to work with our insureds. We want to, you know, ask our questions well in advance of renewal, receive that information, have a dialogue where that dialogue's required, share what capacity we can, you know, put on the tower when we're talking about larger towers very early on. So I'd say that the most important point is, you know, don't be leaving things last minute. I'd say it's not one of the years to do that. And that would be kind of my key bit of advice.
Yeah, and I think it goes back again what we said earlier, just about being prepared, preparing your client for making sure they've got those risk management tools in place. A client will know, and everyone will ask themselves honestly, if they're looking at their cyber policy thinking, actually, it's really affordable, I don't need to worry about the budget this year and stuff like that. They're not looking at the true investment of it. And I think we can't turn around and say this industry is going to have a 20% rate increase, this one's going to have a 50%. It is on a client on a base by base basis, and also of the controls that they have in place. And so, like Laila just said, prepare and prepare early, then we'll be able to work with the client.
Yeah, and just one last comment, I guess, on that is around underwriting information, which really comes down to that risk selection point. And, you know, I think you'll expect a lot more people looking for information in writing these days, which perhaps wasn't the case previously. So don't be alarmed by questions or requests for information in writing. And transparency is definitely viewed as a positive when it comes to risk selection, I would say.
Great, thank you. Eliminating that information gap between clients and underwriters, I think, is the key message, and doing it early and staying organized. Okay, well, I think we've covered everything. Thanks for all the questions in the chat. Pat, I'll turn it back over to you.
Thanks very much. And so that will do it for today's session. Quite a lively discussion, and I hope everyone found it as eye-opening as I did. Thank you again to our panel and moderator for kindly sharing their time and expertise with us today. Excellent job. Be sure to join us in 3 weeks on July 13th, when our topic will be the claims transformation process. Our panel of experts will talk about what's going on in the claims space right now, including ransomware attacks, the U.S. hurricane season, how new technology is changing the claims landscape, and what's being done to develop claims resiliency. Our expert panel will consist of Carrie Bond, head of claims for Lloyd's in the U.S., Beth Diamond, group head of claims at Beasley, Mike Lent, president of delegated authority at Sedgwick, and Forbes McKenzie, founder and CEO of McKenzie Intelligence Services. Before you leave today, please take a few moments to complete the brief 4-question survey that will appear in your browser. Your feedback is the single biggest determinant of our content, and we always welcome your insight and critiques. You can also drop us a note anytime at usevents@lloyds.com. So until next time, let's keep staying connected, stay safe, and have a great rest of your day.